Now, in the big moves in the equity markets and in the commodity markets, less attention obviously is being paid to the fixed income space, but it's still important to look at because the developments in that space go far beyond the geopolitical tensions that are currently plaguing the global risk markets. It has to do with the unwinding of easy monetary policy by large economies across the globe. Joining me to speak about this in a little bit more detail is Dhaval Kapadia, Director, Managed Portfolios, Morningstar Investment Advisor, India. Thank you so much, Dhaval, for taking the time and pleasure speaking with you. You know, I was going to start by asking about the various factors that are affecting fixed income market here. Sorry about that. I should have waited for you. I was going to start by asking about the various factors that are affecting the Indian fixed income market. But in the context of what we're seeing in the recent past, it goes beyond just monetary policy and fiscal policy. It goes to geopolitics and how that is also affecting global markets. So what does the Indian investor into fixed income have to bear in mind as of now in terms of the factors that are affecting the market?
I think, you're right to that extent that, at least as we speak today, the factors affecting fixed income market in a way have sort of broadened, right? I mean, earlier the focus was primarily on growth dynamics in India and how RBI views the growth versus inflation sort of move in that sense. But with the geopolitical risk, I think the primary thing to watch out for would be, and which is some of which we've seen today, is the impact on commodity prices, particularly crude oil. And as we know, India imports a bulk of its of crude oil requirements. So, a spike in prices is obviously going to be a concern to us, not only in terms of the import bill, but also importantly in terms of the impact on inflation. So, I think that's very critical to watch out for on crude oil as well as impact on other commodity prices as such due to what's happening out there. And just moving away from inflation, I would also think that depending on how this situation in Europe progresses, I think one will also have to watch out in terms of impact on growth, right? I think we've seen a fairly strong recovery in growth in most countries across the world as such, including India. We've seen a fairly good revival in growth. Now, whether this situation changes any of it, I think only time will tell. There are no clear answers, but I think these are the two areas to sort of watch out for: the impact on growth and, like I said, the impact on commodity prices leading up to inflation as such.
Okay, let's delve a little deeper into how this impacts monetary policy here in India. In the most recent policy, you had the Monetary Policy Committee of the Reserve Bank of India maintain a accommodative stance, and a lot of expectations were building up that they would not do that, and that at least there would be a sort of a normalization in the, at the risk of complicating things and making this a little technical, the liquidity adjustment framework by the way of increasing the reverse repo rate. But to put things simply, Dhaval, there was an expectation that things would start slowly going back to normal, and that some of the policies that were put in place at the start of the pandemic to bolster growth would now start getting eased out. Do we see that now halting, and is there incredible pressure now with the imported inflation, with crude, for the RBI to act? And could that action happen much faster than was previously anticipated?
Yeah, I mean, I think that's a very interesting point and an argument in that sense. And I think it's a little bit early for us to take a view purely based on that, because one also needs to keep in mind that although we spoke of crude oil prices moving up and how it impacts our import bill and effectively also inflation, but another sort of area which has been driving the pump prices or the petrol or diesel prices in India has also been the taxes that are charged by both the central and the state governments, right? So and what we have seen some time back as well, the central government decided to roll back some of the taxes. Some of the states followed through as well, right? So if that adjustment were to be extended or were to be made further in that sense, that could sort of reduce some of that impact of crude oil prices, although not entirely. But all said and done, I think it is a concern that if crude oil prices remain elevated and if commodity prices remain elevated, eventually it could feed into, the inflation forecast that RBI has made. And like you said, surprisingly, the RBI, in a way, had slightly, mild inflation forecast for next year. I mean, they forecasted that inflation would come down to about 4.5% or so for the entire, coming financial year, which is, FY 22-23. So some of those forecasts might come into question if commodity prices, particularly crude, stay elevated. And it's not just, and just to sort of close out that point, it's not just about petrol or diesel prices being higher, but it's also the roll down effect, right? I mean, if petrol is expensive, transport prices increase, diesel is expensive, I mean, food prices and a lot of the commodities that get transported across the country would also tend to see an increase in prices. So that's, that definitely is an area of concern, but it's too early, it's just been a day since this is started off as such. So I think we'll have to wait and watch how long this continues and how long, the impact of that on commodities and crude oil would remain as such.
Okay. Let's also. So what I'm trying to do at this point, Dhaval, is to talk about the various aspects that will or that are influencing bond yields. So we'll come to that in just a bit. One last question in terms of the liquidity management and how that is changing. What are your expectations in terms of what the RBI has done, both in the recent past and also what it's expected to do in the future? It seems to be moving the anchor back to the repo. Again, trying not to complicate it, but how do you think that the liquidity scenario will change going forward in the near term?
Yeah, I think, like you said, some of this has already been happening. So what happened, obviously, after, if you just go back, to the first wave and when the pandemic hit us, just very quickly is that obviously the RBI, in its endeavor to support the economy, support the financial system and so on, obviously, increased or the level of liquidity that was being made available to banks so that they could lend further to corporates and so on and so forth. Now some of that has sort of, in a way, stabilized, right? I mean, the economy seems to be sort of stabilizing in that sense. And there is a significant amount of surplus liquidity in the banking system, right? To the tune of about 6 to 7 lakh crores is what, banks have in terms of surplus liquidity. And because of that surplus liquidity, the short-term interest rates, I mean, when I talk of short-term is for instruments, with less than 1 year maturity, those had sort of gone below the repo rate and they were trading and the yields on those instruments were fairly low, in the range of about 3 to 3.5%. And RBI wanted to sort of bring it closer to, the reverse repo rate, which is currently about 3.25% and the 4% repo rate. So effectively, what they did is that they've been undertaking some liquidity operations by which the rates have been brought closer to the repo rate, which is 4%. So effectively, they've not sucked out too much liquidity, but then certain operations that they're conducting, and the way they're conducting them in terms of variable rate, repos and reverse repos and so on. These have brought these have sort of at least resulted in rates, rising and coming closer to the repo rate. In terms of, and what RBI indicated in the most recent monetary policy is that they will continue to do that. So they haven't really signaled that they will, try and squeeze liquidity a lot. So effectively, what they've said is that, they want to ensure that growth remains durable and sustainable, right? So keeping that in mind, whether it's interest rates or liquidity, as of now, they haven't made too many changes to that framework. It's just a little bit tinkering in that sense. But going ahead, I think depending on how the inflation and the other dynamics that we just spoke of, how those evolve, I mean, those could impact, how RBI looks at liquidity and interest rates per se.
Okay, so now that we've spoken about the various factors that are affecting bond markets, that are affecting fixed income markets, let's get into what your expectations are in terms of the yield curve and how you expect it to move. Heading into today, based on everything that's happened, Dhaval, a lot of projections coming in of a flattening of the yield curve. How soon do you anticipate that happening, and where do you see the yield curve moving?
And just to take a step back, when we talk of flattening of the yield curve, what does it actually mean? Essentially, if you look at, and when we talk of the yield curve, essentially it is what bonds at various maturities are yielding, right? So you create a yield curve starting with, say, 3 month or even shorter instruments, and going up to the longer tenure, 10-year and beyond kind of instruments, to see what yields across, various maturities are what bonds are offering in terms of yields across various maturities as such. Now, what has happened over the last year or two is that the yield curve has steepened. So what does that mean essentially is that short-term rates have remained relatively low, whereas a medium to long-term, the 5 to 10-year kind of segment, yields on those bonds and those government securities have moved up, due to a variety of concerns, whether it is additional government borrowing or inflation and so on. So effectively, the spread or the difference between, say, the 1-year Treasury bill today is at about the 1-year Treasury bill today is yielding about 4.5%, and the 10-year government bond is yielding about 6.7, 6.8%. So the difference is about 2.2 to 3.3% over the 1-year Treasury bill, and this is higher than what we've seen historically. So historically, this difference has been in the range of about 1 to 1.25%. And today, as I said, over the last few months, this spread has been greater. So effectively, the expectation is that, like you said, maybe over the next, few months or quarters, the yield curve could flatten. So effectively, what might happen is that the shorter term rates might continue to inch up over a period of time, based on RBI's liquidity operations and their interest rate, calls as such, or views. And whereas the longer end might remain a little bit more steadier, it might inch up, but not as much. So effectively, the difference between the 1-year and the 10-year or beyond kind of segments could effectively sort of reduce over time as such.
Okay. So you've explained it brilliantly. Thank you so much for that, Dhaval. But in this context, how does the retail investor position themselves? So on the one hand, the advice by a lot of people that we've spoken to on this program as well is that we're nearing the end of an interest rate cycle, and we're likely to see interest rates go up. May not be in the very near future, but we're going to see it sooner rather than later. So how do you position yourself as a retail investor looking at debt mutual funds?
Yeah, I think, obviously it's not an easy call to take, right? I mean, the way I was describing the current situation where the longer term yields or the spreads are we call them as term or maturity spreads, the difference between the 1-year, yield versus the 10 or 15-year yield as such. And those being higher than normal, I would think the medium to long duration part of that yield curve, essentially the 5 to 10-year kind of segment, still looks relatively attractive to us. So therefore, I would think that, as a retail investor, one could park anywhere between 20 to 25% in that segment. Now that could be done through funds such as target maturity funds or roll down kind of strategies as such, or you could also partially invest in dynamic bond funds or a long term gilt fund to try and be able to capture that difference in that spread that you're getting. So that is one part of the portfolio that one could look at on the debt side. A bulk of the portfolio would tend to remain in the shorter end of the curve. So it could be banking and PSU or corporate bond funds, to a fairly good extent. I think that could comprise a larger portion of what of a debt portfolio for a retail investor. So a mix of, like I said, a larger chunk at the shorter end, because there are concerns that interest rates might move up and so on. So that portion of the portfolio would act as a cushion, because the maturity is low. The impact of interest rate movements may not be significant, and whereas you could enjoy some of the higher spreads by benefit from them, by investing some portion at the medium to long end of the yield curve.
Okay, so this is how you play the duration side. But would you say that this is also an opportune time, considering that yields are still relatively low compared to what we've seen in the past, Dhaval? Would you say that one can consider looking at credit also as a strategy? And if someone is looking at doing that, what should their approach be?
Yeah, I would have thought that probably credit as a strategy looked pretty good about 1.5 to 2 years ago. What's also happened as we were talking of on this yield curve steepening and things like that, But what's also happened is corporate bond spreads, right? So which is essentially say a AAA rated public sector bond or a good rated bond. The yield that it offers over similar government security, say if it's a 3-year corporate bond spread, corporate bond or a bank or a PSU bond, the spread or the difference in those yields have come down quite significantly, right? So similarly, even in the AA segment, where a bulk of the credit funds have a higher allocation to AA kind of securities or securities which are AA rated, there also we've seen a compression in the yields. So in effect, I would say the spreads are not looking very attractive at this point of time to venture out in a big way towards credit risk funds. The difference isn't too much. And as an investor, you also need to bear in mind that the expense ratios in a credit risk fund tend to be slightly higher than, say a banking and PSU or a corporate bond kind of or for that matter, even a, target maturity fund. I would think, some of those funds are better positioned, at the current stage. As and when those spreads widen is when one could, look at, some allocation to kind of credit risk funds or strategies.
Okay, I think we've had a very comprehensive conversation today. Dhaval, absolute pleasure speaking with you. It always is, and look forward to our next chat already.
Thanks for having me, Andy.
All right, that brings us to the end of this conversation, but there's another one lined up in just a short while. We're going to be talking about gold, so do stay tuned.